Dividend investing has become a huge part of the finance industry. It is promoted not only on YouTube, but also by financial advisors, preaching dividend investing strategies for decades. But people fail to realize the things which are wrong with dividend investing. Sure, it sounds great to sit and collect your dividends, but as a long-term investment strategy, it's a bit flawed. I mean, if dividends are the best thing, then why do some companies pay dividends and some don't? Well, because people like you and me as investors own a tiny piece of the public company as soon as we buy their stock, and owners are supposed to be compensated for the growth and profits of their business, which is paid to us as dividends. The companies who pay these dividends do so to keep investors' trust and confidence that it is still a great cash-generating business, and it will continue to do so. Whereas other companies that don't pay dividends might not be profitable yet or might be having financial troubles. But we have another group of companies who are extremely successful but still don't pay their investors any dividends. That is because they instead keep the money with themselves to focus on growing the business through things like R&D. Investors of these businesses rely on the stock price to increase rather than a consistent stream of income. And it's not a bad choice either because dividends are not guaranteed. A company chooses when, how much, and if dividends should be paid. This ratio of the annual amount paid as dividends compared to the stock price is called dividend yield, and it can range quite a bit from one stock to another. A decent amount of companies do not want to break their streaks of continuous dividends, even if it takes some money away from their essential business activities, because some of these streaks have been going on for over a century. Skipping even one payment will raise big questions and could also destroy the company's goodwill. But even if the company had to compromise on its growth, you still got paid some money. So is dividend investing really that bad? Well, another disadvantage of dividends is that a set dividend payout takes away the fundamental choice of controlling your money as an investor. Investors love their portfolio. They customize it to themselves and put their time and hard-earned money into it for decades. So when a company in your portfolio pays a dividend, that becomes one of the factors which you just can't control. On top of that, it becomes a nightmare when we start thinking about taxes. Because if the stocks are held in accounts which do not have any tax advantages, then every penny of the dividend you just received is subject to tax. And yes, that's even if you reinvest it. How much you get taxed firstly depends on how much money you make outside of investment income, and secondly, if the dividends are qualified or not. For example, a person making $50,000 a year also makes about $5,000 a year from dividends. Then, for non-qualified dividends, they will pay tax at their income tax rate, costing them about $1,100 in taxes, whereas qualified dividends will be charged at 15%, costing them $750 a year. But then let's say later on, both your income and dividends increase, and now you are making $1 million in income with $100,000 more in dividends. At this point, if the dividends are non-qualified, they will cost you about $37,000 a year in taxes, and if they are qualified dividends, it will still be about $20,000. And you would have been paying taxes on that all your life, which can add up to hundreds of thousands of dollars in taxes. Another aspect of dividends that is important to understand is that the stock value drops by the dividend amount when the dividend is paid. Let's understand that using an example of Company A and Company B. Imagine they are totally identical in size, revenue, and every other business aspect along with their stock value. Both of these companies are sitting on a pile of cash, and Company B decides to pay a 5% dividend to their investors. The value of that company is reduced by that amount because they just gave out that money. Company A is still worth what it was and retained all its money, while Company B is worth the same, but just in 95% stock and 5% dividend yield. So it makes sense that Company B's stock drops in value as soon as the dividend is paid. Therefore, it's totally irrelevant to the company's value if they pay dividends or not. It is just a difference in how that company value is split up. Company B, however, will lose control over that 5%, which could have had a better use for the business. And the investors of Company B now have all these decisions to make about taxes and account types, which could end up leaving them a little less than the investors of Company A. Company A's investors can just decide to hold or sell their shares whenever they want and not be at the mercy of a corporate decision. To be very clear, I am not saying that dividend investing is not going to make you money or that it's a bad investment strategy. Evidently, some people get a lot of comfort from not having to decide when to sell and by giving away a bit of control over their portfolio for a relatively stable cash flow. But there isn't enough awareness about the cons of this strategy. So if you are serious about becoming rich with dividend investing, be very careful about what type of dividend you get and in which account you receive that money, because the small decisions you make now can save you a fortune in the future. So comment below, do you prefer growth stocks or dividend stocks? If you enjoyed the video, then please like and subscribe. Thanks a lot for watching.